Today, central banks play for time as inflation bites. Hello again, it's Martin North from Digital Finance Analytics, with the latest posts covering finance and property news with a distinctively Australian flavour. In today's show, we look at the inflation debate again, as central banks are still talking up the transitory nature of the inflation in the supply chains and believes it will fall sometime soon. In this environment, one way for monetary policymakers to thread the needle is to use hawkish rhetoric to keep a lid on inflation expectations while holding back on the actual interest rate increases that would slow the recovery. But Gareth Aird, the head of Australian economics at CBA, says the upcoming third quarter CPI is a big one for domestic financial market participants. A lift in actual inflation and inflation expectations in the number of advanced economies has markets on edge. But those looking for an upside inflation surprise on Wednesday the 27th of October, like we've seen in other jurisdictions, are likely to be disappointed, he says. Regular readers will know that we have been making the case all year that higher inflation was in the pipeline. Indeed, our expectation for inflation to lift has been founded on the idea that this time is different. Our views appear quite hawkish earlier this year, but the recent inflation data overseas has supported our narrative. That said, a meaningful lift in core inflation is yet to appear in the official data in Australia. That is in large part due to a number of government subsidies and rebates that have put downward pressure on measured consumer inflation over the pandemic. And wages pressures have also been slow to emerge, which has kept a lid on services inflation. That will change, he says, as we move through 2022. But we're not yet at that point. In addition, the emergence of the Delta variant locally pushed the timetable back a little for higher wages and inflation. The pandemic hit the Australian economy hard over the third quarter 21, and that will have implications for inflation over the period. Sydney and Melbourne were essentially in lockdown for the entire quarter, and that will weigh on some parts of the CPI basket. Notwithstanding that, we think the third quarter 21 CPI will show a modest acceleration, he said, in underlying inflation on a 6-month analysed basis, and it'll set the scene for a firmer inflationary pulse next year. Their forecast is for the headline CPI to increase by 0.8% in the third quarter 21, which would see an annual rate dip to 3%. Remember that in the second quarter 21, the CPI leapt up to 2.8% over the year, thanks to the base effects. Tradables inflation is forecast to be stronger than non-tradables, while goods inflation should outpace services inflation. On their thinking, the trimmed mean will rise by 0.5%, which will push the annual rate up to around 1.8%. The 6-month annualised rate, which better captures the inflationary pulse, is forecast to step up to 1.9%. The risk lies with a stronger print, especially, of course, in the light of what happened in New Zealand. Now, the housing component of the CPI is just worth looking at, because under a quarter of the basket, the housing component of the CPI is worth just under a quarter of the CPI basket. It was slightly updated. Now, they looked specifically at the housing component of the CPI, which is worth just under a quarter of the basket, and in fact it was slightly upwardly reweighted in the annual reweight. It essentially comprises 3 components: the costs of building or renovating a home, rent, and utilities and other charges. The government's home builder package has been a success, and residential investment has surged. This has been accompanied by an increase in prices charged due to both a spike in the demand for labour, which allows builders to charge more, and also a lift in the cost of materials. But that lift in output prices has not been reflected in the CPI, given the price rises are discounted by the grants. The measured price of building a home is likely to stay artificially suppressed in the third quarter 21 as the grants continue to influence outcomes, but that will change next year. On rents, their internal data indicates that average rent paid has lifted quite significantly, and the CoreLogic data, which captures advertised rent rather than rent paid, is sending a similar signal. So they forecast that rents rose by around 0.7% in the third quarter, with the risk skewed towards a stronger outcome. And finally, they expect little change in utilities prices over the September quarter. They conclude that the RBA has forecast the trimmed mean to be 1.75% at the fourth quarter 21, which implies quarterly growth rates of around 0.4 to 0.5% over the September and December quarters. As such, if the trimmed mean CPI prints in line with CBA's call, it will be broadly in line with the RBA's forecast. Such an outcome would likely mean that the RBA will not make any material revisions to their forecast profile for underlying inflation in the November statement on monetary policy. And that means they'll retain their current forward guidance into next year. But Bloomberg says that the global economy's supply crunch is propelling inflation at such a fast pace that central bankers may be forced to respond, even though fixing that imbalance is beyond their power. Their dilemma is that it's hard to tell just how much of the inflation is being driven by a resurgence of demand as lockdowns end, and how much by supply strains caused by logjammed ports and shortages of materials and workers. Raising interest rates now would temper the demand that lifted the world out of last year's recession, but do little to ease the supply bottleneck. If shortages then ease as trade returns to normal, policy could end up too tight and throttle recovery. But if the central bank holds back and the supply squeeze endures, that could entrench expectations of higher inflation, prompting consumers and companies to push wages and prices up. In that scenario, central banks may later be forced to hit the brakes even harder. Trying to work out the difference between demand and supply side drivers right now is incredibly difficult, Stephen King, senior economic advisor to HSBC, said recently. Most central banks would probably admit, at least in private, that inflation is far higher than they had initially expected. You can see why some of them are biting their nails and becoming ever more nervous. Worldwide consumer prices have risen more than 4% over the past 12 months, with inflation outside of food and energy at its highest in the past decade, according to JP Morgan. In the UK, where inflation is on course to run at twice the Bank of England's target this year, Governor Andrew Bailey warned on Sunday that the central bank will have to act, even though he's repeatedly highlighted the limits to what central banks can do. Traders are betting the Bank of England will raise its key rate to 0.5% by the end of this year, and that would be in place alongside Norway and New Zealand among the small number of developed economy central banks to have boosted borrowing costs during the pandemic. The Federal Reserve isn't about to join that club anytime soon, but it is poised to give the go-ahead next month to taper its $120 billion per month asset purchase program. And while Chair Jerome Powell has sought to de-link that move from any hike in interest rates, other policymakers have pressed for an early end to the bond purchases so the Fed has leeway to boost rates if needed in the back half of next year. The Fed is broadly sticking to its view that transitory factors are largely to blame for elevated inflation, but policymakers at the September meeting saw risks decidedly tilted to the upside. Investors are now pricing in 2 quarter-point rate increases next year. Greg Peters, the head of PGIM Fixed Income's multi-sector and strategy, questioned how much the Fed could do to counter a rise in inflation stemming from a pandemic-driven disruption to supply chains. "I'm not convinced that the Fed has any control over those issues," he said on October the 15th. "Pundits are talking about the Fed needs to prick the bubble. They need to raise rates. To do what exactly? To fix the supply chain issues? Do you really want to crush the labour market?" The European Central Bank seems set to continue to support the recovery, influenced in part by its own history of overreacting to signs of inflation. The ECB raised rates in 2008 and 2011 before having to turn tail as the economy slowed. President Christine Lagarde said on Saturday that the current spike in inflation is unlikely to last. That view is shared by others. People's Bank of China Governor Ye Gang said on Sunday that producer price inflation, which hit a quarter-century high last month, will start to wane at the end of this year. And the IMF said last week that inflation pressures will mostly unwind in advanced economies next year. And on Monday, Royal Philips NV lowered its growth and earnings guidance after the shortage of semiconductors weighed on sales. Chief Executive Officer Frans van Houten expects staffing costs to remain high even as materials inflation subsides. So if the combination of strong demand and disrupted deliveries continues, it raises the risk that central banks will be forced into an abrupt shift in policy sometime later, said Neil Dutta, head of economics at Renaissance Macro Research. One way for monetary policy makers to thread the needle would be by using hawkish rhetoric to keep a lid on inflation expectations while holding back on the actual interest rate increases that would slow the recovery, according to John Briggs, the global head of debt strategy at NatWest Markets. It's a strategy to buy time to get the other side, he wrote, and hope that the current supply-induced surges in both goods and energy prices eases by the time we see early 2022. A couple of points to make here. First is, of course, the way we're measuring inflation is wrong. It's understating quite dramatically what's really going on the doorstep, as it were. And central banks have developed a bit of a reputation of leaving things too late and hoping that things will come out better than they expect and then have to react. I think the New Zealand situation is quite interesting insofar that there, Adrian Orr has already taken the first step to tighten interest rates. So I am more convinced than some that we're likely to see higher interest rates in Australia sooner than the 2024 that the Reserve Bank has been talking about. And of course there are profound consequences should that occur, not least, given our over-indebted households, higher interest rates will be significant in terms of putting pressure on household cash flows, and those households are already under some pressure, of course, as we've been highlighting before. So, sure, central banks will be jawing at the moment, trying to talk hawkish while not doing anything. But sometimes doing something, rather than nothing, is actually a better strategy. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.